Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Joe Cavatoni, Chief Market Strategist of North America at the World Gold Council, for an update on the latest quarterly report in terms of gold's performance. Joe, it's great to see you as always. Welcome back to Trade Talks, and it looks like the second quarter, it's a supportive backdrop for gold investment and prices.
It definitely was. It was another quarter where we had good performance. Again, we're still dealing with a lot of headwinds as it relates to the monetary policy, but overall, including the OTC flows in the gold market, a 7% quarter compared to quarter, second quarter for the gold demand worldwide.
Was there any change quarter over quarter? Were the reasons for performance relatively the same?
I think there's a few things that are consistent, but some changes within them. Number one, central banks continue to be a strong buying sector. They were up 100 tons, but within that we saw one market in particular, I think we previously talked about it, Turkey, a net seller after being a long-term buyer of gold. They're dealing with a lot of onshore geopolitical issues. They're dealing with also monetary issues onshore, selling the reserve gold in their central bank into retail and high net worth individuals, kind of dealing with that onshore. But aside from that, we're still seeing that trend of central banks buying. I think what we continue to see as well, some of the differences, we continue to see surprises, but maybe in places that we weren't expecting. Another strong quarter in the US, for example, on coin and bar demand, a 13-year high in terms of the quarterly flow at 32 tons. And then in case of China and jewelry, to our surprise, we saw a bit more flow than we would have expected.
Yeah, well, I mean, it was certainly a risk-on quarter, especially when it comes to US equities.
It most certainly was, and we actually have been seeing that in the ETF flows. When you see risk on and flows into equities, rotation around bonds, and what you're seeing in the gold ETF space, flat to down numbers and significant outflows in terms of the markets in Europe, in terms of the overall ETF flows. So that's telling us that those investors that are speculating around gold or using those instruments to hold gold are paring back, freeing up some cash, maybe looking at other areas, but not yet coming back into the market.
Let's look ahead a little bit here, because elevated geopolitical issues, and not even just abroad, but certainly domestically, macroeconomic uncertainties. Fitch downgraded U.S. debt, right? And part of the reason was governance and fiscal management. Is that a tailwind for gold?
It's actually a great question, because it was probably one of the most interesting weeks for gold. So on the back of the unexpected kind of surprise downgrade from Fitch, the Asian and European gold prices started to show a strengthening in gold. But what came out during the course of the day in the US market were the employment numbers, and they surprised the wrong way. They were stronger than expected, signaling the economy is looking good, and monetary policy took the headwinds back and basically took the pricing appreciation out of the gold market. So what that's telling us is the systemic events are good for gold. They do have an impact on it, but the real big dog in the room right now is actually monetary policy in the US. That's still the headwind for gold right now. So we're going to wait to see how that plays out. Whether we have a soft landing, which looks a lot more likely than maybe we had thought earlier in the year, or we have some sort of a harder or recessionary type of an environment. So either way, both environments will bode well for the gold market. You'll probably see a more aggressive pricing performance for gold if we have that hard recessionary type environment. And if we have the soft landing, then we'll have good performance from gold, but it'll be more of a safe haven addition to a portfolio over time.
We're also going to an election year, and this election cycle will probably not be like anything that we've seen before. Certainly highly contentious, and of course, part of Fitch's downgrade was governance overall. Does that impact gold, or from a historical perspective, how has it performed during election years?
I think what's going to play out as we go into an election year. Now, the outcome of the election has an impact on gold, but it doesn't have as much of an impact as how the rhetoric leading into the election will. So we're going to start to see tensions develop between the two political parties. Things like trade, China, geopolitical risks, they're all going to come to the surface, and it's going to start to probably create an environment of a nationalistic, bring it all home. And that's going to be an environment where there's going to be questions around how the U.S. is going to perform in those kinds of tense discussions leading into the election. That's going to be a good environment for gold, because it might mean weakening dollar position, it might mean concerns around trade, it might mean concerns around the U.S. nationalistic behavior kind of pulling back, and that would be an environment where gold will flourish. And again, that's all lining up to continue to support a central banking environment to continue to have these record-setting moments where they continue to diversify their reserve portfolios and buy gold and add it.
All right, Joe, appreciate the insight as always. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.